Hello Proponomics people, and for today's video, which is from Easter Saturday, so the 30th of March 2024, I wanted to do a little roundup of Q1 2024 and just frame exactly where the UK economy is at this time, because I think it's very easy to lose track. It's very fast paced, there's things going on every day. When you're updating forecasts like I am on a regular basis, sometimes you're updating those every day, sometimes only every week or month, but it's the old if the facts change, I change my mind, sir, what do you do? So, this video is going to be about exactly where the UK economy is at the moment, at the end of Q1 2024. So it's a bit of a chance to zoom out, reflect for a bit, and take stock. So first of all, if you start with currency, we're about 126 against the dollar at the moment. That looks pretty strong compared to the Liz Truss days when we were down in the 1.0x. We hit 1.04 at one stage. Lots of people were saying we were going to go to less than £1 to the dollar. It's around about the same as, it's a bit stronger than where we were when we had the Brexit referendum. We had a big drop from about 140 to about 120 into the teens for a little bit. So it's not too bad at the moment. And of course, this is based on a number of things, but the relative strength of the currencies compared to their interest rates. The US are currently 0.25% higher than us. So you'd expect the dollar to be relatively strong compared to history, but about 125 these days looks about where we're at in reality, so not too much to report there. The FTSE closed yesterday 7953, so we closed on Thursday, at 7953, nearly at that magic 8,000, which it couldn't sustain before. I've got a big bee in my bonnet at the moment about stock markets around the world, because what nobody's talking about is the fact that we've had basically 25% inflation, certainly in the UK, over the past few years. It's actually about 22.7 since the end of 2019. That's where we are. So would you not expect the stock market price to inflate by roughly the same amount, because all this nominal money is all worth much less than it was? Frankly, yes, I would. So what's the real FTSE? That's what would interest me. But this is not a stock market channel anyway, so that's just my soapbox rant. GDP growth rate at the moment, minus 0.3. That was the last quarter, as we know, quarter 3 2024. Had a little look at that last week. They didn't revise it. That was the initial figure, and that's the first revision done. We're still at minus 0.3. Revisions can go on for up to 2 years, and they can be quite large. I mean, you might remember that last year we had an amendment in 2021 that was really quite significant, put a couple of % on the GDP growth. It was a bit of a surprise and got swept under the carpet by most, because most people don't know what to do with that news. But of course, it can be forgiven during a pandemic, because information reporting channels don't work as well as you might hope that they would. What's the annual GDP growth rate at the moment in the UK? Minus 0.2, not ideal, but we put on 0.2 last month. Well, I say last month, but that was January's figures. And I reckon we put on another 0.2 at least since then. So bit of a wash. Remember, GDP is reported net of inflation. So actually there's been plenty of nominal growth, but inflation has eaten all of that up. And this is that stagflation that I talked about a couple of years ago, when I talked about the likely consequences of the inflation we were going to see on the back of the COVID stimulus. And sure enough, stagflation has been here probably for about 18 months now. We need some real powering forward growth. Unfortunately, these days, powering forward is about 1%, although 1% is not small money. We're talking in the tune of £25 billion plus added to the gross domestic product of the nation. So not small change. Wouldn't mind that as a donation to the Proponomics channel if anyone's got it sloshing around. Unemployment 3.9, it was up from 3.8. That is not a bad figure at all. Historically, 6% was considered pretty strong. 3% these days are considered basically full employment. We have been down at 3.5, which is pretty fantastic. But the trouble with the headline rates is they can hide a whole multitude of sins. And what's hiding those sins at the moment is how many people are on the sick list. 500,000 plus more than there were at the end of 2019, thanks to the pandemic. Inflation, 3.4, CPI, you know that I like to dig further into this stuff. Wages ex bonus, 6.1, services inflation, 6.1 as I record this video. One of the reasons why one of the Bank of England hawks from the committee, external member Jonathan Haskell, came out the other day and said, look, we're nowhere near rate cuts yet, so don't get excited. And that changed a few things in the markets. Month on month inflation, 0.6. That's from February. You can't read too much into a February because things change around January, February because of January sales and things like that. So you do need to be a little bit cautious. But 0.6 is not what we want to see month on month for a 2% inflation rate. But like I said, February. So we can shrug our shoulders and look at that over a quarter more than over a month. Base rate 5.25, been there since August. As you'll know, September was that meeting where I think they should have voted up and gone 5.5. If they had done, we'd probably be looking at rate cuts already. Instead, we've had to stay a bit longer at the 5.25. It was a gnat's whisker. It was 5-4, the vote, that meeting. It was a really must have been a heated debate. It was a close one. Balance of trade, minus 3.129 billion. We're always running a negative balance of trade. Not as bad as it has been over some points. We've got some highs and lows over the last 40 odd years. The highest, 9.5 billion in front. The lowest, 12.75 billion behind. So minus 3, not so bad. And then we look at government debt to GDP, 97.1, the current reading, up from 96.6. That's still at the end of 2022. That's how slow they are with some of these metrics, unfortunately. Whereas the best that we've been, 21.6. That was incredible. We had some really good growth around the Blair years and John Major's years, to be honest, that took us to some really nice low numbers. Where's the worst that we've been? 211. I mean, I think we touched 250 odd in the 1940s for some stage, but 211%. So nowhere near our record. Not that we would want to be near that record, but that's where we are. Business confidence currently on minus 3. Lowest point ever, minus 87. And the best point ever, plus 55. Plus 55 is probably as dangerous as minus 87 because it's probably people getting overconfident, but that's where we are. Manufacturing PMI, we had a nice surprise this month as we printed a 49.9. Lowest ever 32.6, highest ever 65.6. So 50 is the magic number for to beat in terms of growth. So manufacturing seems to have recovered from massive boost in 2020 and 2021 for those who got involved in PPE and the likes. Massive drop off as everybody bought too many hot tubs and exercise bikes during the lockdown and things were wound back in. So we've had a tough couple of years. We might be getting back to steady state, maybe even a little bit of growth in that sector, which would be great. Services PMI, which is the much more important one because it's much bigger as a percentage of the economy, printed 53.4. What's the worst it's ever been? 13.4, but that would be a COVID number, so you could probably get rid of that. What's the highest it's ever been? 62.9. That's rapidly expanding, and that would be very inflationary if that was going on. So we don't really want that. 53 at the moment is about the best number we could possibly print for services PMI. Nice and steady, little bit of growth, getting us back to where we need to be as an economy. Consumer confidence, minus 21. Worst ever, minus 49. Best ever, plus 10. So shows you we're not an overly confident bunch as a nation, not overly cheery. Inside those figures, if you drill down a bit, there is some confidence that personal financing is improving over the next 12 months, although not as much as Jeremy Hunt would like to see, because really we have got a nice runway here for a bit of growth, bit of wage growth, the households to do a lot better than they have done over the past 18 months, which is great. Retail sales month on month, an absolute flat line, but there had been a big boost in January after a very disappointing December. Again, really just need to return to stability. Retail has been struggling in the same way that manufacturing has been struggling. Too much sold 2020, 2021, too much growth too quickly. Then a big contraction as people move back to services, leisure, hospitality and all the rest of that stuff. When lockdowns were over, we need to get back to a bit of normality. Corporation tax currently sitting at 25%. From 19, still low by G7 standards. My personal view is the next government will probably look at corporation tax at some point, wanting to go to 28 or similar. That was a number mentioned by Jeremy Corbyn. If it happens, it happens. It is what it is. Business owners just have to suck it up, I'm afraid. The bigger companies, we'd like to be paying 28%. The problem is, of course, the more the rate goes up, the more avoidance you encourage, and the more intellectual property suddenly appears in Bermuda or all the rest of it, because suddenly it stacks up for companies who are making lower profits than the very big boys like the Apples and everybody else who has got the most optimised tax structure you could ever imagine. The more expensive you make it, the more those optimised tax structures percolate down through the smaller companies, and ultimately the goal should be to take as much money as possible, not to charge the highest rate possible, because they aren't the same thing. But 19 was very low, and I look at the recent highs over the last 50 years, 52% was, that was absolutely crippling. So 1970s were not a friendly decade sometimes for that sort of stuff. And then personal income tax rate, well, the top rate, we're now at, and I prefer to state this including the national insurance because it's pointless otherwise. So including the national insurance, you've got your 12,570 personal allowance, so you're at 0. Then once you're into your personal allowance, ignoring the difference in the thresholds for national insurance and all the rest of it in terms of employee, you're going to get to a 28% now marginal tax rate if you're working, because you're going to pay 20% income and 8% NI, and that's from next month, right? So that's progress, because it was 32% effectively. Then at the higher rate band, you're going to pay 42%, so that's 40% income, 2% NI. And then at the higher additional rate band, you're going to pay 47%, so you're still paying that extra couple of percent on the NI. Actually, what the Conservatives have done in this area is really quite progressive, helping out people who earn less money and helping out the workers, not helping out the pensioners, but then the pensioners are helped enough by the triple lock, is the logic. At some point, if they want to get rid of national insurance, if the Conservatives by any small chance were to stay in power, they're going to need to move some of that. They're going to need to move that basic rate of income tax up to more like 25% in order to get rid of NI altogether. Wouldn't be a bad idea, in my opinion, because it's all a bit of smoke and mirrors and a bit of a con, and I'd like to see people who are working keep more money in their pockets. And actually, really, really interesting enough, since 2010, the only part of society that has benefited in terms of take-home pay, when you look at the tax structure, is actually the bottom 20%, which is incredible. But the Conservatives have moved the personal allowance up so much. So you'd have to remember that certainly the bottom 10%, people are not even earning the personal allowance. These are people whose circumstances probably restrict them to only working 16 hours a week or similar. And in those sort of jobs, it's very difficult to get much more than minimum wage. So it's really difficult to get a fulfilling part-time role that's got any career progression opportunities. That's just, unfortunately, the way that it is. So that's an economic roundup of where we are in the UK at the end of Q1 2024. I'll try and do some more of these at the end of the quarters, because it's good, as I said at the start of the video, to zoom out, take stock and understand where we are. And actually, in conclusion, I think we're not in a bad place at all for the relatively limp economic growth that a very highly developed economy like the United Kingdom can achieve in this day and age. And I think we've actually got a pretty good grounding for growth going forward. The trouble is we've got all this debt to service, and the interest rate situation needs to be managed, but we do somehow seem to be being able to keep control of that for the moment. The problem is the rate's going to go down too slowly, such that the net fiscal drag, as people drop off their fixed rate mortgages and as companies drop off their fixed rate debt, the net fiscal drag is going to be negative, because basically the new mortgages are going out the door at an average rate roughly at the moment of about 5.3%, whereas the existing stock of debt is at about 3.4% on average. And that number's going up all the time because people drop off lower rates and are going on to higher ones. Whereas hopefully that new rate is coming down and down and down ever so slowly. It was 6.4% at its worst point last year, which was really bad. So how the housing market stayed together quite as well as it did is a testament. And the reason why it stayed together as well as it did ultimately is because transactions effectively contracted quite a lot. So by about 20 to 25% fewer transactions than you would expect in a healthy property market year. What does that mean? Well, of course, some of those transactions were brought forward into 2021 because of the stamp duty holiday, but it does mean there might be a bit of a backup. And what you're seeing at the moment on the open markets, interestingly, is more stock than you've seen for at least 8 years in terms of what's available on the market. So this is going to keep the market pretty honest. There's plenty of stock out there. Clearly, sellers have been waiting to put property on the market while the market isn't crashing, but relatively flatlining. What's going to push it forward? Massive increases in wages, as have already been alluded to, and inflation in general is going to push it forward. So that doesn't equal a 0% housing market. That equals a prevailing rate of inflation housing market, which is about 3 to 4%. Now, of course, that all lags, and it's not as simple as that, but you get a little bit of insight there into where I get some of my forecasts from in terms of what's going to happen to the property market pricing in the next 12 months. I hope that video is useful. I'd love it if you got to the end to leave me a comment. Subscribe, tell your friends about the channel, share on social media. I'd love to get to 1,000 subscribers. I'm only 44 away. Thank you very much.